Hi, it's Rob again with Perfect Spiral Capital. Welcome back. We're in the second part of our Enhance Your Knowledge series. And as a part of this series, we're looking at common financial topics that are often misunderstood. Today's topic is going to be one that maybe some people are definitely familiar with. We're going to be looking at saving, and we're going to talk a little bit more about what those real definitions are on the topic. So, to get started, I want to first talk about definitions. And we're going to look at, much like we did with inflation, the dictionary definitions, and then expand upon that a little bit further. From there, we're going to talk about the components of saving, and then we're going to look at the different types of or ways in which someone can save. So, let's get started. The Britannica definition of saving is as follows: the process of setting aside a portion of current income for future use or for the flow of resources accumulated in this way over a given period of time. So, I don't know about you, it sounds pretty basic, fairly straightforward. Much like we did with inflation, I have my own definition. I like to call it more of a true definition of savings. And that is the safe placement of money or earnings with the protection of principal and liquidity along with prevention of loss. So as we see, there are definitely two different types of versions of that word, but I think when most people are contemplating what saving is, it does tend to fall more so in the line of what I just explained. And it's understanding that someone has access to the money, they're easily able to access it, it's protected, and they're not going to lose anything, so to speak. So in order to really think more about saving, let's talk about what some of the ideal targets are for saving. In a lot of cases, these are concepts that we would maybe like to apply when we think about how we protect our money. Let's jump into some of these ideal targets for savings, if you will. So the first one is going to be protection or zero loss. Most people, myself included, when I put money into saving, I certainly don't want to experience any loss. I want those funds protected. And as we've talked about in other videos, there's different places in which to protect that money, but we're going to avoid getting into all of that, at least for right now. And we're going to talk a little bit more about protection for just a second. So one of the things that we've talked about, particularly in the last video, is inflation. When we think about protection, inflation is one of those areas that we also need to protect against. And I don't know if you've looked at your local bank lately, but you certainly may have seen that that rate in which you're earning on those savings probably does not keep up with the rate of inflation. Second, the next area is growth. And this is where that previous comment about inflation really comes into play. That savings should grow. It should be able to hold and grow with inflation. Now, I'm not talking about investments. I'm not talking about putting money in an IRA or a 401k or anything like that. I'm talking about safe access to money. So in addition to the growth, we also have liquidity, and that means ease of access to our money. We want to be easily able to access those savings to deploy it as we see fit, which ties into the next point of control. We want to make sure that we have control over the money, that we can use it in the way that we see necessary, which also ties into flexibility, meaning that not only are we able to access the money in the way that we see fit, but it's flexible in how we're able to use it for many different areas. Doing so without concerns, without question about what we're doing with those funds. Hopefully that it's not getting reported to the government for some reason if we're pulling out a significant sum. Our last point then is probably one that is most often necessary, and that's stress reduction. Having a large amount of savings prevents stress. It gives us a cushion. It provides this ease in our mindset, knowing that we have a significant sum available to us whenever we need it. I want to make sure that you're thinking about these core concepts as we progress through the rest of our video today, thinking about those areas as we kind of talk about some of these different concepts as it pertains to the process of saving. So before we get into ways to save, I think it's really important that we talk about what saving is not. And what do I mean by that? Well, what saving is not is putting money at risk. And all too often today, and this is one of the major reasons why I wanted to have this as one of our first aspects of this series, is saving is protection. It is prevention of loss. It is li- liquidity. It is all of these different things that we just talked about, right? So if that's the case, we should not be putting money at risk if we're trying to save. What types of risks exist? Well, if someone's putting money, unless it's into some sort of a money market account where you do have a little bit more security, that it really should not be placed into a 401k or a Roth IRA or something along those lines. Why? Well, think about the concepts that we just talked about. A Roth IRA or a 401k actually has limitations on liquidity. It has limitations on control. It has limitations on access. And if those funds in those accounts are also at risk in the market, we have now lost out on the protection aspect of saving. It's really important that we stay grounded in these core concepts of what saving is so that we can think about it in the right way. When we think about saving in the right way, we'll know what to do and where to place that money. Next, I want to talk about a couple of different things. I want to talk about ways we can save money. Now, this may or may not be fully all inclusive, so don't beat me up too much in the comments about it. But I want to talk about some key areas in which we can put money away and have it safe and or protected. So let's talk about these three different ways in which you can save. And maybe there's more. I'd like to hear some thoughts on what maybe you have, but these are the three primary ones that really come to mind, at least in my opinion. So the first one would be a typical savings account. I think this is something that everyone's familiar with, and one of the first accounts most anybody sets up. Now, they certainly offer some level of protection being in a financial institution. They provide liquidity or fairly easy access to money. They also do provide some level of growth. Now, again, it's may not be at the level that a person would appreciate in terms of being able to keep pace with inflation, but there is something there. As a part of that growth, something we have to keep in mind is that there are taxes on that growth, meaning that you will have a 1099 at the end of the year based off of the level of growth and interest that has accumulated on those funds. One of the things that's probably the biggest detractor for a primary savings account is the low growth rates. And you're not going to see the level of growth in which to keep pace with inflation. Now, another option to that a lot of banks have come out with more recently in many cases has been a high yield savings account. Now, what these accounts do is offer the same type of protection from a savings standpoint with a bank, but yet they have a higher level of yield, meaning that they have a higher level of growth that is intended to kind of keep up with inflation. At the same time, depending upon how fast inflation is going, those rates may or may not be at a place where they're going to outpace inflation. Additionally, in both the high yield savings account and standard savings account, one of those detractors is that the rates are variable. They're changing pretty consistently. We've seen rates go from maybe 1% in a high yield savings account to over 4, near 5% through the early 2020s. And now we've seen that they've been coming back down anywhere between 3.5% to 4%, give or take, depending upon what institution someone might be with. Now, again, it's not a bad place to have your money necessarily. Again, you will have, much like a standard savings account, any growth that is taking place within those accounts is going to incur some level of taxable situation, typically through a 1099 through interest that needs to be reported as income. The third area that I'd like to talk about is one that's a lot less common, that most people are not familiar with. Although if you've been following my channel, you probably have a good understanding of what I'm going to talk about next, and that is dividend paying whole life insurance through a mutual provider. Why is this a potential option as a savings vehicle? Well, with a properly structured or properly designed uh, policy, such as what we do here at Perfect Spiral Capital for each individual's tailored situation, what we end up with is a scenario where we have guaranteed growth, we have dividends, we have a place in which all of the funds are highly protected, even more so, some would say, than even the typical banking institutions. And that's a whole different topic of conversation, but I'd be happy to answer those questions for you. In addition to that, there's liquidity that's provided, meaning that there's liquid access to funds within those policies. Separately, there is tax deferred growth and it's income free tax transfer upon death. In general, we have a lot of great tax advantages by utilizing this type of a contract. Another great aspect of a dividend paying whole life insurance contract with a mutual provider that is available is obviously what it's intended for, the death benefit. That death benefit, typically in the way that we structure contracts with our clients, that death benefit is just going to continue to grow year over year over year until ultimately the insured person passes away. But those funds are going to be significant in that it's going to help propel the savings for the next generation when we've taken the time to properly educate them about the process. I didn't intend to dominate this entire conversation about the core concepts of becoming your own banker and some of those areas, but when we think about saving, to not consider that as an option would be doing a disservice. Now, there might be other ways that we could think about saving. Somebody could buy a bunch of gold, they could store it that way. It might be a store of value, and that's an option too. Some people do that with precious metals, and I'm certainly not going to fault those. I think those are decent options. But when we think about our core concepts of what saving is, if we go back to that, when we think about protection against loss, we think about growth, we think about liquidity, control, flexibility, stress reduction, there are limits to a lot of these other options from a savings standpoint. And even within a savings account as a whole, when we think about dividend paying whole life insurance with a mutual provider, it does kind of check all these boxes. And that's an important thing to be keeping in mind as we think about options for saving our money. In our first video in this series about inflation, we talked about how it's eroding the purchasing power of virtually any dollar that we make, both now and in the future. And we have to think about that as just one of those items that we have to consider when it comes to how much we save. Most people are only saving from what's left over after they've paid all their bills, after they've did all that they were planning to do with their funds, their mortgage, car payments, etc. And they're saving only that portion of what's left over. So this means that people are saving much less than what they should be. And it's because we are all kind of, in some way, shape, or form, haven't overcome Parkinson's law. Parkinson's law says that a luxury once experienced often becomes a necessity. So what happens is, as someone makes more money, they find ways to spend more of that money as things continue to progress. And that typically happens and starts out very early. It's about teaching ourselves how to prevent expansion of our spending to equal our income. So we have to think about, how do we save differently? Now, without knowing someone's specific individual situation, I can't tell someone how much they should or shouldn't be saving. That's really a personal situation. I want to pose a couple of questions that I really intended for you to internalize and think about. The first is, how much are you making in annual income today? Multiply that number then by the total amount of years you anticipate to be working. Take a look at that number, write it down. How much of that number do you want available to you when it comes time for retirement or passive income? Separately, how much of that would you want to be guaranteed to be available to you when it comes time for retirement or passive income time? Lastly, in these questions, How would it change your life knowing that you have this secure financial foundation to build from and to work from? Still thinking about that total amount of money, that conventional wisdom of saving 10% of your income and putting it in the market, doing whatever you need to, and hope that it reaches this predetermined amount is more of a situation of hope. To me, that's not really a strategy. It's really hoping that things go a specific way so that you can achieve the level that you're after. What I what I like to think about is how can I create a system in which I can make those things happen where all those variables tend to be known. And that's really what the types of strategies that we talk about here is redirecting where those funds go first. What we like to educate our clients on here at Perfect Spiral Capital is the process of implementing the truth blueprint. And the basis of that is Nelson Nash's infinite banking concept. That process and that redirection of how money flows through our hands. And again, think back to that number, your current income multiplied by the number of years you have left to work. How much of that do you want to flow in through your own potential banking system, through your own saving system, and then flow out to where you need it? That's a big part of what we practice here in how we coach and talk to people to allow them to start saving a much more significant portion of their money than what they would be normally. Now, I know there's going to be some people out there that are probably detractors or people that are really hesitant, and that's fine. I was too when I first heard this concept and I first started thinking about how to save. However, one thing that I think is great for people to understand is that implementing the truth blueprint and implementing the infinite banking concept will take anything or generally any strategy that you're already doing, and it's going to only make it better. It really does enhance most anything that you're already planning to do. How do I know this? It's because I've been doing it personally, and it really works. And not only that, many others have been doing it as well. At the end of this video, there's going to be a link to a course that's going to help you understand if it might be the right fit for you. And again, this isn't personal financial advice. We're simply asking you to take a look at things differently. And I don't want this to feel that it's all marketing. It's not really what it is. It's more so helping you understand ways in which you can save more of your money and put your money to better use for you, for your family, and for your future generations. I hope that you found this video valuable today. I hope that you were able to learn something different about how to save and what saving really is as opposed to maybe what saving isn't. And if you found it valuable, feel free to like and subscribe for future video content, and we'll talk to you again next time.